It has always been a moment of celebration for ARK Invest until a massive fall hit the hedge fund giant. Can you imagine the ARK ETF lost around 40% of its value in 2021, while the S&P 500 has gained about 25%? The gulf between ARK's investors and the rest of the world is worrisome. The macroeconomic climate is ultimately responsible for the company's underperformance. If these issues are not addressed, ARK Invest will continue to fall. How could this affect the financial market from a bigger perspective? This video will cover 3 essential market updates that most people miss out on this 2022. Are you new to this channel? Subscribe and hit that notification bell to help us produce more wealth-building content. You can count on Dinero Association to keep you up to date on the latest financial and economic developments. Cathie Wood. Most people did not see these 3 things coming. Cathie Wood thinks we could be experiencing a significant market catastrophe. Concerns about inflation and rising interest rates prompt algorithms to penalize riskier equities. Only a few stands out: excessive valuation multiples, low profitability, falling sales growth, and insufficient cash reserves. Zoom and Teladoc, 2 ARK companies, share these ideals. These 2 stocks are on the point of extinction, having plummeted over 70% from their all-time highs. Teladoc is ARK's second largest stake, while Zoom is its 4th. An experiment conducted by Cathie and other ARK employees has yielded promising results. In practice, it reduces the volatility of her portfolio while simultaneously increasing returns. How did the experiment turn out? Continue watching and let's find out. Cathie has severe problems with 2 of her primary shorted stock positions behind closed doors. The stock prices of Ford and GM have risen sharply in recent months. Market watchers expect increased electric vehicle spending from Ford and GM. Value investors are buying Ford stock because the vehicle's features are superior to the Model Ys of Tesla. It's only a short period before the automobile giant gets started on the greatly awaited Ford F-150 Lightning with the Mustang Mach-E. The automaker also touted a new line of electric vehicles, the majority of which would be ready by 2024. Joe Biden lauded Mary Barra, the CEO of General Motors, for leading the charge toward electric vehicles. Most of these innovative goods end up costing consumers a fortune. Sales of electric cars are expected to keep rising. 3% of all vehicle sales are made up of electric automobiles. If you remember, President Joe Biden celebrated ambitious electric vehicles goals by automakers at the White House on August 5, 2021. According to GM, electric vehicles only account for a tiny fraction of total vehicle sales, at less than 1%. Ford is in the same basket, with only 1.4% of its total sales from electric vehicles. Ford and GM stock will not climb in response to this. The 2 companies are increasing EV sales, but they are losing money simultaneously. To make matters worse, Ford and GM are already in a precarious financial position. Ford owes $110 billion and GM owes $74 billion in capital lease commitments. Investors were happy with GM's 30% increase in its electric car spending goal to $35 billion. Because of its soaring stock price, Ford decided to expand its electric vehicle investment to $30 billion in 2017. As of this writing, Ford's and GM's credit ratings are both near junk status. It will be difficult for both automakers to come up with the money to fund such a large EV investment plan. For both of these automakers, borrowing money at high interest rates is a necessity. Bad credit ratings are a result of low gross margins. In comparison to Ford, GM's gross margin is 14.5%. Although Tesla has a gross margin of 23%, the company is frequently slammed by investors for its inability to make money. Ford and GM could go bankrupt rapidly if the EV boom undermines their earnings. Value investors prefer heritage automakers because of their low price-to-earnings ratios. In terms of price earnings, GM has a forward PE of 8, while Ford has an ahead PE of 10. Consider the impact on their stock prices if these two automakers go bankrupt. Ford and GM's revenue may soon vanish. Ford and GM also reduce profitability, spending billions on electric vehicles. Hey, take a breather there for a moment. If you have not yet subscribed, please click the subscribe button to ensure that you don't miss any of our videos. What are these three things that I am talking about? Number 1. DNA sequencing, robotics, AI, and cryptocurrency will definitely change our lives. Cathie Wood is excited about the rapidly developing innovation platforms on which their research has been focused. DNA sequencing, according to Cathie, will revolutionize healthcare. The second category is robots, which could eventually collaborate with humans. Many people, however, are concerned about the impact of robotics on jobs. Yet, as we've seen with this pandemic, there are substantial labor shortages, particularly in highly repetitive work that robots excel at. The third one is energy storage. She said that she never expected the coronavirus to spark a boom in interest in electric vehicles. On the other hand, electric vehicle sales have surged while gasoline-powered vehicle sales have remained flat. Then, according to the most current data, the cost of artificial intelligence training is falling at 60% annually. Last but not the least, there is blockchain technology. The most recent developments are DeFi, or decentralized finance, which most believe will take a significant amount of market share away from traditional financial services businesses. And NFTs, or non-fungible tokens, which are redistributing a considerable amount of power back to the creator. It's been incredible to witness NFTs soar in popularity this year, and we expect that trend to continue in 2022. What do you think about these developments? Are they advantageous to the majority of the population or simply a threat to middle-income earners? Number 2. The consumer market is falling. As a result of the supply chain concerns, businesses may have scrambled a little too much in the second half of the year 2021. And it is expected to see some inventory challenges in 2022. In the United States, consumption growth has slowed. According to the latest University of Michigan findings, consumer sentiment has reverted to the levels last seen during the coronavirus pandemic. Consumers, Cathie believes, are upset by inflation and will make some adjustments, particularly now that their savings rate has dropped below 8%. Then there's China, where the government's measure will have a more significant economic impact than most economists anticipate. As a result, some cyclical concerns may arise next year. The coronavirus was the driving force behind both innovation and acceptance in 2020. This year, we saw a shift away from technology and towards cyclical companies such as energy, financial services, minerals, and industrials. On the other hand, we take it all in stride because we have a 5-year investment horizon. Keep on watching. The last point could be the game-changing speculation. Number 3. Technology rules. There is no stock bubble. ARK Invest technique would be highly effective if we were in a bubble, which we are not. Cathie admires about 2021 because rather than continuing to support their plan entirely, the stock market has diversified. This isn't typical of a bubble, which favors a small number of stocks. Furthermore, bull markets that aren't in a drop have a tendency to break beyond fear barriers. and there's a lot of anxiousness going on right now. Many skeptics believe that development will continue to be slow. That is not really the case. If you look at the growth rates of technological companies during the peak of the coronavirus, you'll notice that they were actually accelerated. On the other hand, Zoom is still growing. It climbed by 35% in the most recent quarter, considerably outpacing the economy's growth rate of less than 10%. Tell us what you think about this video by leaving a comment below. We are Dinero Association, your partner in building wealth.